So
Awesome. Thank you, Patricia. Thank you so much for all your help. Uh, Hello, everyone. My name is Alex Scurr. I'm the lender in-house down at the Keller Williams Coastal Properties site in Long Beach. I've been on a few of the team meetings, and I'm assuming a lot of you have seen my face on a couple of other presentations. I did go through a little bit of these items the last time I was at the team meeting, but I had to go through it so quickly that I thought it would be pertinent to try to share again and see if we could take a little bit longer to discuss the different ways of doing contingent purchases. It is hands down the most frequent situation and question that I get from the agents in the office down here in Long Beach. And I think it has to, also be a big part of the market up in LA as well. If there are some of you on here from the other offices, so I'm going to go through slowly some of the different ideas that I've come up with and the different options that we have that you can take tidbits of to share with your sellers who are looking to then go and buy or potentially retain their house and then go and buy. Um, I'm not super familiar with the app, so if there are questions, if there are things that you want to ask, please let Patricia know. I know she's on there monitoring for us. My contact information is going to be on the last slide. My cell phone is readily available. My email is readily available. So if you want to do a one-on-one, talk about some of the details that are presented in here, that would be more than happy, and I'd be more than welcome to do that. So taking it away, we are going to start with just quickly what is a contingent purchase. Anytime the property that your client wants to buy is subject to another transaction, whether it is the sale of that house they currently own or even a refinance on that house of they currently own. The purchase is contingent upon something that these guys need to do, some way of obtaining funds to apply to the new place. The options that I'm going to present today are one, bridge and cross collateralization financing, two, the possibility to rent out the current property that your clients own with a rental agreement, three, accessing the equity that they have in the current property they own through a cash out refinance, whether that's with a mortgage, first mortgage, or possibly using a home equity line of credit. And then I'm also going to dive into quickly what the current rates are at the end of the presentation, and also just, a few little quick tidbits on what's happening COVID related as well. So taking it away, a term that gets thrown around a lot is a bridge loan. And I just want you guys to be aware that they don't really get done very frequently at all. So again, the term gets thrown around a lot. It's a suggestion that a lot of agents make to their clients. Hey, you just do a bridge loan. Hey, just, it's easy. Just get a bridge loan. They're not that easy to do because the property that they're selling needs to have a lot of equity in it. It's not just, a loan that someone who bought their $500,000 condo a few years ago and has 50 grand equity, 100 grand equity into it can do. So just keep that in mind, but they are still out there in the market. They're really, really good for higher end properties when there is a lot of equity in it and that higher end property has a long, like a long marketing timeline, possibly, to, 1.5, 2, $3 million house don't sell in a month. So if your client that owns that house wants to go and buy something, they can either do a bridge loan or they can do cross collateral loan where they actually get one loan across the two homes. And that's down there at the bottom of the slide there. Cross collateralization, one loan across the two homes. It works well for these situations. But as you can see in the slide, rates are typically a lot higher. This is a short-term loan to satisfy the need of accessing the equity to then buy the new place. Then you come back once the property is sold that they currently live in. You would possibly most likely do a refinance when you can apply a lot of the closing funds to the new mortgage. As you can see, the terms on the bridge loan are really, typically pretty short, 6 months to a year. And yeah, that's really it on the bridge financing. You can by all means suggest it, and I'm happy to talk to people about them. They again just don't get done very frequently, so keep that in mind when you do make those suggestions. Questions there? Right? Moving on.
No questions yet.
Okay, thanks. Okay, another scenario that is, I think, a good one. It doesn't necessarily net you as agents, multiple transactions, but retaining your real estate is a great way to achieve wealth long term in your life. So if the clients have savings and potential access to down payment for the next leg up, they can turn their current property into a rental property. And I'm sure you guys have seen this. The concerns that I'm presenting here on the slide really quickly are, what kind of down payment do they have access to go and do the next place? We really need 5% down or more. I mean, you can do the next purchase if it's owner occupied, usually with 5% down, as long as it's in, the $800,000 space or lower. If it goes above that, they need to start to bring in upwards of 10 to 20% down. And, the other concern is debt to income ratio. The clients that are renting out their current house to buy a new place need to be able to qualify for the new mortgage plus the difference of what the rent amount is compared to what they owe and have to pay on that current house. We can use the rental agreement to help offset the mortgage payment on the house that they're departing, but it's not all of the rental amount. We can only use 75% of that rental amount. So sometimes there is a delta between the rent and the mortgage payment. So they do need to make some money. They do need to have a little bit of access to down payment. There are other ways that I've seen happen for the achieving of the down payment. One being a gift from family, the other one being dipping into a 401k or an IRA that the client may have saved money in, and then coming back after the fact and replenishing those two accounts. As I noted there, we can use about 75% of that rental amount to offset the mortgage. And then, if they change their mind after they purchase the new home and they want to come back and sell the property that we rented out, that is, that's fine in that case. That would just be a situation where they decided, hey, renting, we don't want to be a landlord anymore. We just want to come back and sell that property. You can then go in and take the proceeds of that sale and apply it to the new mortgage, which is what I have there, the bullet point that says recast payment. I will have another slide on the recasting of the payment as a really clever way to get your client's new mortgage to the point that they ultimately want the monthly payment at. And just, it may take them a month or two or three to get it there, and they would just have to take on the bigger payment for that short term. But I'll touch on that later in the presentation. But yes, this is a really great way for people to retain their real estate and continue to move up. Any questions there, Patricia?
Not yet.
Great. Okay, next slide. Here are some other solutions, but these require a little bit of pre-planning. Okay? If a client comes to you and they want to buy a new house, but they don't have any down payment yet, let's say they have equity in the current house that they own, they can do one of two transactions on that current property they own. One of the first one is doing a cash out loan to achieve and obtain the down payment. That is usually done on a fixed loan, which is safer, and also the rates are, typically pretty low in today's market, somewhere in the low threes for a 30-year loan. The other option is called a home equity line of credit, which I'm sure you guys have heard of, but this is the best way to describe a home equity line of credit is to think about it like a credit card on your house. You have a line that you can borrow against, and you only pay on the amount that you borrow. This one's really helpful here if there's going to be a long time frame on the client finding the new place, because then they don't have to pay on that mortgage until they they don't have to pay on that home equity line of credit until they actually get ready to use it. And if they did the cash out loan and they didn't find a place for 6 to 8 months, they're paying on a new loan for that amount of time and kind of throwing some money out the window. The drawbacks to the home equity line of credit are they are done on adjustable terms, they are interest-only payments, and they essentially turn into a balloon payment after 10 years. So the client would need to be able to get rid of that loan, typically in that first 10-year time frame, to keep it in a safe way. So the answer is not what is better. There isn't a fixed answer to the question what is better. It really is client and situation dependent. And I would go through each of those options with them. But this slide, remember, again, the most important piece about this is that there's some pre-planning involved with this transaction. If there isn't the ability to do the pre-planning, the question of can this be done simultaneously arises, and the answer is yes, but the only option is the cash out loan for that, and they would have to do the cash out loan on their current property as an investment property because they will no longer be living there once they're buying that new place. You can't do two owner occupied loans at one time. So the terms and the amount of cash that they can get are impacted by the fact that that loan on the property they currently live in is deemed a investment property loan. So that's what I mean there by the concerns. Definitely doable. I've done a few of them, one with an agent in the office by the name of Nina, and it went really well. The one escrow company from our refi sends the money to the escrow company for the purchase. So it's totally possible. It's just the client needs to be okay with a little bit less aggressive terms on the current property that they own because it is that investment property. Okay. The next slide here is the part about the recasting of the mortgage.
Alex,
yes.
sorry. Denise Manugian, she said, if the client's current house is for sale, can they still get a cash out or home equity loan?
Great question, Denise, but the answer is no. They would have to take the house off the market if they wanted to do a refinance transaction on it. The house also cannot be listed for sale if they wanted to do a transaction on that property alone with any bank. But great question.
Thanks, Alex.
Sure. Moving on. Recasting the mortgage. Okay, this is something that is not everyone knows about, and it is a really, really cool and useful tool in this situation. And what it essentially allows a client to do is purchase a home when they currently own a home with low down payment, and then after that transaction is completed, come back, sell the other property, take the money that they make, put that money towards the new loan, and get their client's loan at the place that they ultimately wanted it. So really the problem always comes is, to me, with the client saying, hey, I want my new payment similar to what I currently pay. and I want to use all this equity in my house to get it there, but you as the agent come back to them and say, hey, your contingent offer is not going to get accepted. So let's figure out a way to, at the end of the road, get your payment to where you want it to be, but also get you the new house, and then come back and not be rushed to sell your house for less than top market. And this is the solution. Okay, there are a few things that come into play. The client would have to take on the higher mortgage for a few months. They would have to potentially have the other mortgage for a few months as well. But at the end of the day, they're able to take the proceeds of the sale of their house, call it $100,000, $200,000, however much it is, and go to the bank that has the new loan and say, hey, I just got this lump sum of money. I want to take this and apply it to the principal, and I want you to recalibrate the mortgage payment based on the lower amount of money now for the remaining amount of the loan. So let's say they've had the loan for 6 months. They would take that lump sum of money, put it towards the new loan, and they would have the new loan over 29 years and 6 months instead of 30 years. Hopefully that makes sense. But that's how the recasting is done. And again, it works really, really well. And if it's 3 months or 6 months, hopefully the clients can stomach the larger payment for that amount of time and remove the need for the contingent purchase for you guys. So a couple of the tidbits there. It's not a refinance, which is really cool because they don't have to go back and then requalify for it. So we don't have to do credit check again. We don't have to review their pay stubs and their bank statements and their tax returns. I said that there, the lump sum is applied to the principal balance. So, $500,000 turns into $300,000, and their new payment is based on that amount. They do sometimes need to qualify for the multiple loans if we aren't turning the place that they currently live in into a rental property. I can touch on that with your clients and their specific situations. And then the last thing is that it only costs really about $150 to $200 for the bank to process it. So much cheaper than a refinance, and ultimately achieves the same goal. The rate that your client gets when they obtain the first loan is the rate that they retain even after this recasting process. That's always a question, so remember that. They keep the same rate. It's just the new loan is done based off of the amount of the term remaining, so 29 years, 6 months, or 29 years, 8 months, however long they've had the loan, and it's based on the new mortgage amount with the lump sum that they apply to it. So definitely keep this in mind. It's a great way for you to describe to your client how you can work around the contingent purchase.
Alex?
Yes.
Ann Baum, she said, would they have got better terms, though, on the loan with a larger down payment at the initiation of the loan?
Great question. So it's really credit score dependent. Low down payment loans, the interest rates on those loans are really good still. 5% down interest rates today are still right around the same place that the 20% down interest rates are. But the client has to pay mortgage insurance. So the answer is yes, they would have gotten a loan without mortgage insurance. But when you come back and you're able to recast the loan and apply the amount of money that you make from the sale to the new loan, the mortgage insurance would go away. So yes, again, to answer your question, you would have a little bit less attractive terms, but I think a couple $100 of mortgage insurance per month is well worth the ability to get into a house without having to do a contingent purchase. That's my take. Is there any follow-up question to that, Patricia?
There's a bit of a delay, so I'm going to give her a minute. But I just have to say I agree, because that was how my husband and I got into our first house.
Good.
And no follow-up question.
Okay. Great. Great question, though. Thanks, Ann. The next slide here is just a few items that aren't specifically pertinent to you guys, just something that I want to put in so that if the client asks you, they do need to have a little bit of extra money as well if they want to retain that current property when they go to buy the new place. The bank likes to see reserves, especially now with COVID. But these reserves can be in a 401k or an investment account. They can't just completely deplete all of the money that they have to do this. So keep that in mind because that question may come up. And then in the space of purchases below $800,000 in LA and Orange County, this next bullet point is not pertinent. But when you start to do these transactions with the larger purchases, the million, million and a half, $2 million, the equity in the house that you are keeping and potentially turning into a rental needs to be significant. So let's say your client has a house, they don't want to sell it and they want to go buy a new one, but they also want to use a rental agreement to offset the mortgage that they have on there. And the purchase of the new house is $2 million. The house that they're retaining needs to have at least 25% equity in it to be able to use a rental agreement. So just keep that in mind if you're thinking about this for the bigger purchase prices, that it does get a little bit stricter on the underwriting guidelines for those. But if you're under $800,000 and you're trying to do this, the amount of equity in the house that they're leaving and retaining doesn't matter. They could have 5% equity and we could still use a rental agreement to be able to offset the mortgage amount on that property. Questions there, Patricia, at all?
No, nothing yet.
Okay, cool. This is going to be my last slide on this presentation. Just a quick update for you guys. Interest rates are incredibly low. Conventional loans under $510,000 in LA and Orange County, sub 3%. I'm sure you guys have seen that all over the news. Anything over 510 in our county is around 3%, up to that 765 loan amount. Jumbo loans are 3.25. These are all 30-year fixed loans. The 15-year loans are in the mid twos, and then your government loans, the FHA, VA loans are somewhere in the high twos, 2.75. This is for people with relatively good credit, 740. But these are the rates again for 5% down, 10% down on those conventional loans, and it's really a good way if you have some sellers that are thinking they want to go and buy, but they're waiting for their house to sell. If we could get in contact with them to explain the alternatives to the contingent transactions, that's why I'm here. I know it is, something that you guys deal with on a pretty regular basis. So if my email will be on the next slide, and I can send you these presentations. I have a couple of them. One that I did with the office meeting, and then this one, which was a little more detailed, to forward off to your clients as well. The last thing I want you to keep in mind is that when you're dealing with self-employed clients, if you do a little bit of scrub of your clients lending wise when you're meeting them as a buyer's presentation, and they tell you they work for themselves or they tell you they own their own business, you have to be really careful right now that they are back in business and that they're doing business, or else loans are not working. So definitely keep that in mind when you're meeting with your buyers. Make sure that they either are a W-2 employee and still collecting their salary, or if they are self-employed, they need to be somewhere in the ballpark of experiencing less than about a 20% decline from the previous year to date in their income for them to be able to still do a loan.
Okay.
And
sorry, I have some lawnmowers, but there's a question from Denise Manugian.
okay.
How quickly are loans closing on conventional loans?
For purchases or refinances, I'll touch on both. Refinances right now are taking somewhere around 45 days. There are banks that are doing those quicker, but a typical timeline for a refinance is 45 days. purchases, because rates are so low and banks are so busy, are somewhere in the 25 to 30-day time frame. We always have the ability to do things quicker. It just would depend on the intricacy of your client's finances. If they're self-employed and they have their money coming from all these different places, then their transaction will likely take longer than someone who has the down payment sitting in their checking account and they are making 120 grand a year in a salary. So it really is slightly client dependent, but 30 days on the purchase is safe to still write offers with, and 45 days if your client is doing a refinance transaction would be my answer to that question. So if there aren't any more questions that pop up, I am going to stay on for, I would say, maybe 5 minutes here because we have till 11:30. Please let me know. The contact information for me is going to show up here on the slide. That's my cell phone, 714-746. Oops, that one's actually incorrect. 714-746-8295. Sorry about that. That's really silly. My email is there, nalfinancial, .com. This is an embarrassing slide. So cell phone, 714-746-8295. Email alex@nalfinancial.com. And if you guys do have questions, Patricia, Taryn at the desk here can forward your phone calls to me as well anytime. I'm readily available and happy to help you any way that I can. So just going to stay on here for the moment and see if I can't change that cell phone and email.
And I can post it right here in the thread, also on Facebook.
Let's see here. There we go. Typing too quick today. Is that up, Patricia, with the correct information?
Yep.
Awesome.
714-746-8295.
That's the cell phone, text, call. That's the email. Happy to help. Happy to talk to any clients about these scenarios. So thank you very much for coming on and spending your lunch half hour with me. Thank you guys for all the faith in me.
That was great, Alex. You gave a lot of good information. And I'm hearing from escrow departments that escrow companies that finance companies are just getting slammed right now because a lot of people are refinancing. Are you finding that to be the case?
Yeah, definitely. I mean, the banks are really busy, but they've hired, it started right before the pandemic really hit, where rates started going a lot lower. So banks started ramping up their, the infrastructure within them. They hired a lot of new underwriters. They had a lot of new funders. They've hired a lot of people. So banks are trying to catch up, but they are very slammed. I mean, everyone in the country could refinance at this point, to be honest, if they ultimately wanted to. I don't think it's, beneficial for everyone, but if your rate is somewhere in like the 4% range, I would definitely suggest that you reach out to your clients to have them consider looking at, either a new 30-year loan to lower their payment or potentially even dropping the term so they pay their house off, quicker and start paying more towards that principal.
Yeah, that's a great reason for agents to make some touch calls on their clients.
Totally.
That's great. And Ann Baum said thanks. This was all really useful.
Of course, Ann, thank you for coming on. Let me know if you have any more questions. The right contact info is up on the slide now.
All right. Thanks, Alex. That was great.
You're welcome, everybody. Have a good day, weekend. Get out there and stay safe. Thanks so much again.